Our next speaker, we are honored to have the CEO of IRAExchange.net, Mr. James Jones, join us here from sunny Arizona. Originally from the Boston area, the Massachusetts. You might notice a little bit of an accent, but I think he's going to get out in the sunshine and chilling. But here to spread a little sun and shine in on some of the different things you can do with your IRAs and stuff like that. So James, man, so honored to have you join us here on Note Camp, man.
Thank you, Scott. Really appreciate being here. And the accent, by the way, is probably a blend of the two worst, both a little bit of New York and a little bit of Boston. So please forgive me.
Hey, nothing wrong with that. Nothing wrong with that at all. So, Jim, why don't we first, when we were talking the other day, why don't you share a little bit about your background and how you got into doing what you're doing now? Because I think it's a really, really valuable context for folks to get a bit of a feel for you on where you're coming from.
Yeah, you bet. So started my career at Merrill Lynch in wealth management, managed about $525 million in assets. And our world in those days through the 90s and into early 2000s was really publicly traded securities, stocks, bonds, mutual funds, and ETFs. And so when we talked about diversifying a portfolio, I think about how naive we were in that it was publicly traded securities. So when we went through the 2001 meltdown, we had a fair amount of our stocks in blue chip stocks, New York Stock Exchange. We saw investors lose 60% of their portfolio. Fast forward to 2007, 2008, when NASDAQ was going to the moon and everybody was making all kinds of crazy money. If you were invested in NASDAQ stocks, all technology, you saw an 80% dip in your portfolio, which took you 11 years to get back to even. So after that, I made a conscious decision to move into alternative assets. When we talk about some of the best managed portfolios in the world, I referenced the Yale Endowment Fund, best track record since 1985, 17% average return, 40% in real estate related assets. And that's the majority. More millionaires, I don't have to tell you, made out of real estate related investing, right? 30% private equity, private debt, venture capital, only 20% in publicly traded stock, bonds, mutual funds, and ETFs. Really opened my eyes. The way I got into the industry was actually going to work with a self-directed IRA custodian also, which I'm not ashamed to say, although I kind of am ashamed to say. Being a Merrill Lynch broker, we were supposed to know a lot about a lot. Never heard of a self-directed IRA. And it took me probably 9 months working at the custodian to understand it. I thought, okay, I'm really not smart enough. I think I'm just going to go back into the industry. I really don't get it. It's so complicated. And after about 9 months, things started to click and gel and say, okay, I think I got this. This is really interesting. There are thousands of asset classes that you can invest into. And again, the number one asset held in self-directed IRAs, real estate related assets.
Yes, it is. How much total do you think is held? I've heard different numbers out there, but as far as what's truly every IRA is self-directed, but in truly like a self-directed custodian, it can be in notes and real estate. How much do you think is invested in self-directed IRA custodians out there? Any idea?
So there are 50 million IRAs in the United States up into the recent decline. There was about $35 trillion in retirement assets, of which about 12 trillion is in individual retirement accounts. The ballpark is 5 years ago, there were about 150,000 self-directed IRAs. Today, with the explosion of cryptocurrency, that's changed it and skewed it. But if we exclude cryptocurrencies, it's estimated somewhere maybe about 500,000 self-directed IRAs invest in alternative assets.
Wow.
So it's extremely small, 1% to 2% of the IRAs out there.
Mm-hmm. And I've heard from different folks talk to me about how the self-directed IRA companies often will have at least, usually 25 to 40% of their assets are managed. They're sitting in 0% accounts waiting for somebody to give them a phone call, or it's sitting there waiting to invest in a deal in a lot of cases.
So from this perspective of the self-directed IRA custodian, that's really where they make their money. So, let's a quick backup difference between a self-directed IRA and a brokerage account IRA. They make their money on transactions of product, right? Or more recent today, assets under management. The way a self-directed IRA custodian makes money is by annual fees. We can touch on that a little bit later, but the annual fees that they make is about break even. Where they really make their money is on the float. That cash sits in the account, and the numbers that you gave is absolutely correct, dead on correct. So there's a lot of cash that is just sitting there. So most people think, okay, well, no problem. I'll just send that cash back out to my Schwab IRA. And again, the self-directed IRA custodians make it sticky, in that there's usually a substantial exit fee to send that money out. So you need to be aware of that.
Yeah, exactly. Now there's a variety of different funds. What are the annual contributions that somebody can invest into a self-directed IRA right now for those that are brand new out there? I mean, there's different levels, but can you talk about a little bit some of those different contribution levels?
Yeah, so the similarities between a self-directed IRA and a brokerage IRA, don't want to get too technical, so forgive me, but it falls under IRS Publication 590. And that's what the IRS allows you to do in terms of contributions, required minimum distributions, et cetera. So the technical operating parts of that. And so contributions for 2022, $6,000 a year. If you're 50 or over, it's $7,000 a year. And that, one of the things hopefully also we'll get to is some of the changes with the Secure Act for ages 60 to 63. They're going to allow about a $10,000 catch-up provision.
Very nice. Very nice. And then, of course, they've got ESAs, educational, for $2,000 you can put away. And then you've got different levels for SEP IRAs and solo 401ks. And then also you can self-direct even your health savings account too, correct?
Yeah, that's unfortunately little known. So there really is an education fact. Most people don't realize that if you are self-employed, you can do a solo 401k or a simple or a SEP, which is, it's a type of a pension, if you will, for self-employed people. And yeah, absolutely. You can take a health savings account and you can invest in notes and make returns consistently higher and hopefully with less risk than the market.
Well, you can invest in notes and real estate. You can lend money on that stuff out to other investors. There's a lot of great alternative investment. Be part of a syndication, invest in apartments. There's all variety of different things. It's just that people don't know what they don't know, right, James?
And the point that I make, being an ex Merrill Lyncher, to all of your members and your followers, if they know notes better than they know the stock market, they shouldn't be investing in notes. Right?
Invest in what you know. I think it was the best advice I've ever been given by any of my coaches out there. Invest in what you know. If you don't know it, if you want to get to know it, great, get to know it. But if you don't know, and most people, they don't take the opportunity to know it. So that's why they end up investing at the peak, and then when they're upset because then, a lot of times there's a downfall after the peak. You got to know it and know when to act and when to take, when the market conditions work best for in a lot of cases,
So I'll give you an anecdotal proof of that, right? And one of the most successful strategies on Wall Street that the institutional traders use, this is really interesting. Think about this. It's called the odd lot theory. So most brokerage firms, high net worth investors, institutions invest in what's called even lots, 100 shares, 1,000 shares, 10,000 shares. Right? Odd lots are the little guy that'll buy 7 shares of Amazon or 14 shares of eBay. And so on what's called the level 2 trading, you can actually see who's lining up on the bid and the ask. And so if you see odd lots, if you do the exact opposite of what the odd lot is doing, meaning i.e. the little guy, that is one of the most fantastic successful strategies on Wall Street. Just do the opposite. To your point, they typically buy on the very high in the peak and they sell at the very low in the trough. The average investor in stocks makes about 2% a year return.
Wow, that is a nugget there for everybody. The odd lots. Do opposite of the odd lots and you'll probably come out. Wow. That I never heard of that. That is that's a big nugget there, everybody. Now you've taken your passion for it. You've done some amazing things with IRA Exchange too, besides doing the normal stuff. Because you shared a little bit about me, some of the things that you've done. You want to brag on yourself a little bit here, James? All right.
So I was working with a self-directed IRA custodian, and I had a gentleman come to me, turned out to be a good friend and colleague, was one of the pioneers of crowdfunding. And crowdfunding is simply taking advantage of the new regulations that the government created out of the Jobs Act, so the everyday investor can invest into alternative assets. And so an investor came to me and said, well, I'd like to invest in this crowdfunding platform. So I said, well, this is really exciting. And so I opened the account, we transferred, got it funded, and then we went to make the actual purchase. And the custodian said, oh, no, that crowdfunding stuff, that's all illegal. You can't do that. So he said, so I got back to the customer and he said, yes, I know several other custodians said the same thing. He said, you really should come down to the first crowdfunding conference in New York back in 2012. And I went down there and the light bulb went off. And this was, at the time, there were some other new real estate companies that were out there using Regulation A+ to crowdfund and source, right? And I said, my God, this is the greatest thing. And I went up to the speaker and I said, did you know you can use individual retirement accounts to invest in this? And that kind of became a 9-10 year journey to pioneer the use of retirement assets into these new alternative asset classes. So the group that started, it was a group association. We got invited to the White House for the Champions of Change. It was really pretty neat, pretty cool. Had the opportunity to speak at most of the major conferences over the years. Have 3 books published, publishing a new one that's going to kind of consolidate the other 3 and bring some new updates about the industry, about self-directed IRAs, new things happening with IRAs under the Secure Act. So it's been an interesting journey, but it is a journey that's far from complete, from the sense of being able to make this an easy and smooth process to transact, just like you can, again, with publicly traded securities. Still a little bit of work and friction in using a self-directed IRA.
Right. And that's, making sure the paperwork's filled out, and honestly, sometimes it's just having I won't name any names here, but some of the custodians not to screw stuff up. We joke about equity trust. In a lot of cases up there, killing deals because things drag on. They don't understand the transaction. They want stuff. They want you to commit fraud before actually sending. I gotta have a signed document before I'll fund. Well, I can't give you a signed document till you fund. You know what I mean? And so we've seen a lot of that cases, and yeah, it's frustrating in a lot of cases in some of these different custodians. And of course, people turn over and stuff like that too. But still, it shouldn't be as difficult a process to get a lot of stuff done.
What's interesting about the industry is that almost all of the custodians are using one accounting and administrative platform that's still running off legacy systems. So you'll hear a couple of custodians out there saying, well, we utilize an API, and that's true, but that's used with this provider of accounting and administration that's actually provided by Salesforce.com, the largest provider of small business APIs, right? So in the 3 steps of opening the account, funding the account, and then transacting or directing the purchase of that asset, they have the first part automated. So you can open the account kind of easy. I mean, when they first got into it, what they would say is, come online, fill in all your information online, and then print it out and fax it. You're like, this is not an online process, right? So they've gotten a little bit better. So today, yes, an account can be generated within minutes sometimes, but the second step of funding the account still can be arcane. It's still driven by the investor themselves. So if an investor doesn't know that, or if the investor sends the transfer request to their local broker in Ohio, and the broker in Ohio looks at that and says, oh my God, there's $100,000 going out the door. He puts it at the bottom of the pile, and maybe 60 days later, after making the additional assets under management, it might then make its way to the actual department headquarters of handling transfer paperwork. So it's just that lack of information that people have. And sometimes, to your point, the newer people in the turnover at the custodian just might not be aware. So the industry is still looking for that solution to automate it, and it's getting close and it's getting better. But it really comes from, what's interesting, this industry started as what we'll call a B2C. So it was really kind of one-offs. So you go to Note Camp and somebody goes, oh, this is fantastic. I want to invest. And then they say, my goodness, you can invest using your IRA. So the industry for 40 years was really just kind of one-off investments, and there was no need to change it. The crowdfunding platforms that started to have uniformity in asset classes, there wasn't quite the need or the demand or the scale yet to invest into the technology to automate it the way that the E-Trades and the Scott Trades and the Robinhoods have done over the years. So we're just at that tipping point where scale will have the drive requirements coming from the investors, and it'll tip. And I think within the next 12 months, hopefully we'll start to see some solutions.
Yeah, it'd be nice to see this. Let's see here. We got a couple questions. Carolyn asked a question: if I use a self-directed IRA to invest in crowdfunding, is there a limit on the amounts allowed to invest? There is if it's an outside of a retirement account.
So there's kind of two questions there. One might be around being an accredited investor. All right. So some of these crowdfunding platforms, if they're using what's called a Regulation D, all right, that means that it is restricted or limited to accredited investors. Again, without getting too much in the weeds, you got to be worth $1 million. You got to have 200 to 300 in income, either yourself or the spouse, right? And the minimums are usually $100,000. Sometimes they'll go as low as 50, maybe 25,000 in a Regulation D. In a Regulation CF, known as crowdfunding, or Regulation A+, that is opened up to unaccredited investors. So again, you can invest any amount in your IRA as long as the money is there. And again, the money in your IRA comes from two sources: either rolling over from another IRA or 401k, or a annual contribution, which is limited to $6,000 or $7,000.
Makes sense there. And because there's also a what is it, reg that you can't invest more if you're non-accredited more than 10% or something of your income as well.
Correct. And that's always being reviewed and changed by the SEC. That may change with the Secure Act, but it's 10% or a max of $5,000.
Right.
In some cases, there was a limit of $2,200. I think that was under an A+, not CF.
Right. We're not going to get it. We won't get into securities exchange emissions and all that stuff. And don't start asking questions about that, everybody. That's not what we're here for today. You got specific deals. And Blaine says, I have a Horizon Trust and they move my money 3 days. That's really great. We're not talking about once the money's in there a lot of times. I'll give you a great example. We know most of the major banks, Wells Fargo, Bank of America, Chase, if you're going to do a transfer in kind like that, they're not going to wire. They send a check. We've seen this happen a lot of times because it slows things down. It takes 6 weeks to get the money out in a check and then deposited. And why? Because they can hold on to money for another 6 weeks and make some more fees on interest and stuff like that. So if they slow stuff down, it's difficult these days. I'll tell you that in times.
So here's another little nugget for you. There's two ways you can move money from your brokerage IRA to a self-directed IRA custodian. There's a direct transfer, which is known as a trustee to trustee, and there's an indirect rollover. Please, you only want to do a trustee to trustee. So on the self-directed IRA custodian fees, some of them have tons and tons of fees and forms to print out. You always want to check the box trustee to trustee, meaning from the trust company, Robinhood, Fidelity, E-Trade, to the new self-directed IRA custodian. And what you have to do is make sure you have self-directed IRA custodian ABC, FBO, for the benefit of Jim Jones, account number IRA 12345. So it's going directly to that. And for the first time, again, please, cash only for the investment you're going to bring. You don't want to start bringing over mutual funds and publicly traded securities, because a lot of custodians can't handle publicly traded securities, and that will put the jam in the whole process. And again, that can get lost. So trustee to trustee. If you do an indirect rollover, to your point, you're going to receive a check from that custodian, and the clock starts ticking as soon as it gets mailed, and you have 60 days to get that rolled over. And if you don't, that's considered a distribution, fully taxed. It all comes out of your IRA. And even when they do the rollover, they're going to assume that you're going to keep the money. So they withhold up to 20% tax that you have to make up. So
Yeah,
trustee to trustee direct.
Yeah, I remember being a banker at JP Morgan Chase, and there's always that number. I always have to ask people, are you taking this to the account now? Because you got 60 days. Otherwise, you're going to be penalized, and you don't want to do that. Definitely want to face that penalty on stuff like that for you. Now, there's so many different companies out there. What are some things people should look at when they're evaluating a custodian in your mind? What makes up the questions people need to ask?
Well, if I was going to take the advice from my 13-year-old daughter, go online, Google the company, and look at reviews. I mean, that is just, that's the best advice you could get, honestly. Look at the reviews through Google and Yelp, and it's amazing. There are some really big names of very large self-directed IRA custodians. And there are just some horror stories of things that can happen. And I read through those all the time. And there are a lot of situations where the IRA holder just wasn't aware of the process. And there's some liability on their end as well. But number one, take a look at the reviews. Number two, you want to take a look at the size of the company, how long they've been in business, what kind of Better Business Bureau rate source to take a look at. I would definitely talk to attorneys, CPAs, if you're in notes in the real estate space, attorneys that do that and ask for references and referrals. And then take a look at their website and take a look at their fees. There are still a few custodians that require you to do a checkbook IRA, which we can talk about in a minute, what that is and how that works and why. And so that is a built-in added expense of anywhere from $2,000 to $5,000 for them to incorporate an LLC to use a checkbook. Others won't allow it at all. They're the other extreme, right? They'll say, no, we do not use or allow a checkbook IRA. There are others that have fees for opening the account. Most firms today have kind of waived that, but they're still out there, some $50 to $100 to open the account. Take a look at the annual fees. You can really get nailed here. You can be $295 per asset per year, plus AUM, assets under management, or the size of the value of the account. Also take a look at transaction fees. Some have waived them, some are 25, some are still 125. If it's real estate related, just because there's so much demand in the real estate world, which is about 70% of the assets in self-directed IRAs, they can jack that up to $500 transaction for a real estate related asset. And then lastly, what are the fees to move cash out? Almost everybody is going to charge you some kind of fee for that cash. We talked about the very first thing that's just sitting there. Some is $50, some is $100, some is $1,000. So
yeah, it's important to know what your fees are and what it's going to cost you. And the thing too is knowing you said so assets under management doesn't necessarily mean cash in the account too in a lot of cases, because like when we were born, we're always getting an annual notice, hey, you've got to provide a value of the asset to your IRA investor. So even if it's worth 100 but you only paid 50, put down you paid 50, because if you put down 100, you're going to be taxed. Your fees are going to be off the 100, even though that value is maybe not there yet. Correct?
Yeah. The other probably final point, well, 2 points quickly. One is, again, get a sense for, can you do a lot of these things online? Is there a client portal that you can go see online your assets? Are they using and embracing some kind of basic technology? If it's still the old, fax it, yikes, run as fast as you can. And there was one other point about that. I'll come back to it.
It's okay.
Sure.
About checking.
Got it. Came in back. So there's been a movement where state banking charters are now requiring third-party administrators to list the name of their custodian that does their back office. So real quickly, an actual custodian for a self-directed IRA company is the entity that is registered and approved by state banking charter. And they are audited by the state banking associations. They're reviewed by the IRS. Even though they're non-fiduciary, they do have ultimate responsibility for investors' cash and properly custodying those assets. A third-party administrator, in layman's terms, is pretty much a wholesaler. They're upfront. They're going to bring in investors. They're going to open the account. They're going to do a little bit of a rev share with the custodian. But where the custodian is audited by the actual state banking commission, the third-party administrators are only audited by the actual custodian who's doing their back office work. So there's, again, without implying anything negative or that third-party administrators would do anything wrong, there's just an extra level there of due diligence by the state. So always do your homework.
That makes a lot of sense there for you. Now, James, you talked to me. We were talking about something the other day about how you guys are doing something creative with folks who, or maybe as most people, if they got money sitting in an account, they're not making anything. You want to talk a little bit about kind of what you guys are doing?
Yeah, so we're trying to create a cash alternative, and we have to be careful because the custodian, as we were just talking about, is what's called a non-fiduciary trust company. So they can't get behind an asset, and that's been done over the years. And then if and when that asset goes south, the self-directed IRA custodian gets dragged into the lawsuit. They can be closed. The IRS seizes assets. Yikes. So it has to remain independent. There are some moves by some of the custodians to actually partner with or become a broker dealer. And so that kind of changes things. But one of the companies that we're working with that is it's a cash alternative, is Worthy Bonds, and they basically will pay 5% on idle cash. So really interesting concept. And they're similar to an Acorn, where you can use a card and you can do roundups that's associated. So if you purchase something for $10.10, you're charged $11. That 90 cents gets rounded up into a savings account, of which they pay 5%. But the other part of that is you can buy these bonds within your self-directed IRA and earn 5% on idle cash, which beats the heck out of 0.5% or 0.75%, or being charged $500 to send out $100. That makes no sense, right?
No, it doesn't make any sense.
And we see it happen all the time.
All the time. All the time. Exactly. We had folks reach out. We're going to do a $100 option fee. Like, what? They're going to charge me $500 for this $100. I was like, yeah, I guess you're with the wrong custodian there. Sorry there. Now let's talk, because in the note space, people are using their money to buy. How can people use can people get a loan, or can they finance or leverage debt in a self-directed IRA? Is always a good question too to ask.
Yeah, so this is certainly a big question, one of the most misunderstood. The short answer is yes, you can get a loan, you can finance, you can use debt in a self-directed IRA. Again, the biggest thing that you have to remember is the IRA really is governed by the IRS. We are the beneficiary, but we can't have a benefit directly or indirectly. So it's think of it as a distance, a long distance, right? But so you can get debt or leverage, but it is like a commercial real estate loan. It's based on the asset itself that's evaluated, right? How much money you're putting down. You personally cannot be tied to a credit decision by a mortgage company. that would be a prohibited transaction. So you can't have any personal credit or personal skin in the game or put money into that. That's not considered IRA money. So there are First American Savings Bank is one of the largest. Before 2009, there were probably 100 companies that did that. Today, there are 3 to 5 that will finance debt. But again, it's tied directly to the actual asset, can have no connection to the individual IRA holder. Typically, you can finance up to 50%. In some cases, they'll go to 60. Typically, the interest rates are in the 6% range. That also, as other mortgage products have gone up a little bit, in the 6 to 7% range. But then there's this nasty thing called UBIT, right? And so you can be taxed. And so the IRS always gets their money, always. Did I say always? They always get their money. And so I'll give you kind of a back of the napkin real quick example. So let's say you find a property for $100,000 and you have $50,000 in your self-directed IRA. You're able to get a $50,000 loan on the rest of the property. Now you purchase that for $100,000. Let's say that property doubles. It goes to $200,000 and you decide to take the profit and sell it. All right. So in this case, we made a $100,000 profit, of which originally 50% was financed. So that's 50,000 out of the 100,000 profit. That's subject to a trust tax of 30%. So 30% times $50,000, you owe Uncle Sam $15,000 in your self-directed IRA if you bought a property for $100,000 and you financed half of it.
Mm-hmm. Yeah, and it's also you don't want to run a business through your IRA as well too, because you can run into UBIT if you're running a business through it too, right? A lot of folks deal with if they're professional wholesalers using their IRA on a regular basis to transact business. You can also run into UBIT there too, right?
So that's actually the genesis of how this came about. Somebody was running a pasta company many years ago out of their IRA. And so again, the IRS is brilliant and they throw a blanket over everything. They say, whatever you can't do directly, you can't do indirectly. Well, guess what? That just covered everything. Right. That covered everything. So
that's generic terminology there, right?
So in that case, you would have personal benefits. So in the case where you're running a business, and you're going to use like a checkbook IRA, you cannot pay yourself any kind of management fee. You can be the manager and you can use intellectual property. You can manage the dealings of the IRA. You just can't be paid for it. All right. And there's a whole nother subject that I won't get into, but it's called a ROB, which is where you're rolling over a 401k into what's called a C corporation. That C corporation buys shares in the IRA, and then people can start to run a business out of a rollover 401k. But there are all kinds of requirements, and you can't start paying yourself a salary out of the money of the 401k. You can only pay yourself out of the proceeds and the profits from that. And then that's a whole nother subject for another day. But essentially, to your point, yes, you can't pay yourself as a business out of an IRA.
Carolyn has a question on that last example you gave. Instead of financing 50K and using 50K to buy that, if you just use cash and then sold it for 200K, you wouldn't pay any UBIT on that at that point because it's all investment income without the financing side.
Absolutely correct. Yes. And so there's also, again, without getting too much into the weeds, but again, this is where so many people get nailed with prohibited transactions. I'll touch on that lightly if that's okay.
Yeah, please do. That was going to be the next question.
Okay, so there's a segue there into getting direct benefit and indirect benefit out of that. So indirect benefit out of an asset purchased in a self-directed IRA, a great example is art, right? So if you buy a Picasso and you hang it on your wall in the home, the IRS says that's a prohibited transaction. You're getting personal benefit and enjoyment out of an asset held by your IRA. If you buy a watch, if you buy certain collectible coins, if you buy wine and then drink it, right? Prohibited transaction, right? So you can't have any kind of benefit out of that asset that is owned by that. As well, there's prohibited people. Prohibited people are right in your family line up and down. So that includes a spouse, your children, your grandchildren, and then going up the other side of the tree, a lineal, is parents and grandparents. So any of those people you cannot do business with, or you cannot have any direct benefit or indirect benefit either from them or them from you. So a couple examples. Your son goes off to Boston University and you, oh my God, I can't believe how expensive real estate is in Boston. And so you go out and you buy a condominium as investment in your self-directed IRA. Well, you can't let your son stay in that apartment, even if he pays rent. On the other hand, you can't get his 4 buddies to pay rent and then wink, wink, he also has a room there. That would be an indirect benefit, all right? Can't buy a condominium for your parents in Florida, let them use it, and you certainly can't buy a condominium in Florida on the beach and you go down and use it 2 weeks out of the year. And so when I'm doing these conferences, right, I always get somebody and they always have the same example and it always involves July 4th and beer. I don't know why, but somebody says, Jim, look, realistically, okay, I got a condominium, it's a 2-family. It's July 4th weekend. I'm going to go over there and I'm going to paint the 2 back bedrooms and bring myself a 6-pack. Who's ever going to know? And the answer is, statistically, true figure, 99% of prohibited transactions never get caught. I can almost promise you the IRS will not know that he went over there and painted the 2 back bedrooms at 7 o'clock at night and drank a 6-pack of beer, okay? But it goes the same following with what you do with your taxes when you take deductions, all right? Can you take deductions? Absolutely, and real estate is one of the best asset classes to do that. The IRS says you're allowed to take deductions. That's your obligation is to take deductions and not pay more than you have to. But what you have to pay, you must pay. And so the trick is, or the thing is, the issue is, if you get caught, if you get audited, the penalties are severe. If they caught you within 1 year and you can prove that you were just dumb, well, then you're going to pay a full taxable event on that. If they prove that you did this consistently for more than 1 year and you really knew what you were doing, in most cases, they'll just seize your entire IRA. Gone. Poof. So, you know, it's the same questions as your own ethics and values. Hey, do I want to cheat on my taxes and hopefully I don't get caught? Same issues. If I do a prohibited transaction, my self-directed IRA, and I don't get caught, good for me, okay? But, you know, the issues we see all the time, there are a couple of custodians that have issued debit cards to use, which is brilliant in a way, right? So let's think about it. If you get a call at, 8 o'clock in the morning and the toilet's leaking and you got to get over there and the plumber comes and you're standing in the driveway and he says, I want $200. Well, you can't take the $200 out of your wallet and use your own money, prohibited transaction. But on the other hand, realistically, you can't call the custodian and have them hotwire over $200. You know that's going to take 3 weeks for the custodian to do that, right? So some people have issued and offer a debit card, or you can have a debit card if you open up a checkbook IRA. The promise is the problem is that it's so tempting. People will say, well, look, I'm going to Florida. I'm taking a look at this property. I'll buy my own plane tickets, but I'll buy my wife a nice dinner out with the debit card from them. And again, if you get audited and you get caught, so are the consequences.
That's the thing. You've got to make sure you're not dipping that forbidden fruit.
And keep records.
Yep, exactly. You have to keep everything. Okay, Stephen asked a question. If you put IRA money into a syndication for, say, a hotel purchase, and you own 7% of the hotel that borrows money, and you get a cash distribution from the hotel yearly profits, do you owe UBIT on the yearly income? Because it should go back into it. Also, for several years, the hotel loan is refinanced. Is there UBIT on the new loan or when the hotel is sold? Good question. It's part of syndication.
No, because really, thankfully, this is great. In those examples of syndication, real estate is excluded from that. So if it's other operating companies, yes. If it's real estate, no. There are the rules of if there's more than 25% in an operating company that's retirement dollars, then there is a consequence of having that. Real estate is an excluded class. The other potential question that might have come from that gentleman is the percent of ownership, and this is where you got to be really careful. It's currently, if you own less than 50%, you're not going to have problems of using self-directed IRA to invest into that entity, into that fund, into that syndication. What was proposed in January of this year in the Secures Act was that if you owned any piece of that, you would not be allowed. Thankfully, that didn't pass. It got kicked out. There's rumors that that's going to be readdressed. Likely in those situations, those kind of policies are grandfathered, but just be really careful if you have equity in some kind of entity or fund and own 50% or close to it. You have to really be careful, and always, as always, please check, with a tax attorney.
Yeah, I mean, you definitely need to be talking with an attorney about that. Let me ask you a question. So we've got one of the things we ask people here, James, is we asked a lot of folks to fill out a little bit of a survey about what do they have, what are they big focus on, and roughly, it's good to see roughly 40% of those that filled it out say they have a self-directed IRA of some sort.
Wow, wonderful.
Which is really good. What would you say to the other 60% though that don't?
That's where the money is, right? So a couple things. One is asset allocation. One of the first things we talked about, right? Back in my naive days where I thought diversification was, I got domestic stocks, I got international stocks. No, that's not diversification. Diversification is asset classes like real estate. So, again, if we go back to some of the original numbers, 1.5%, 2% of the population has self-directed IRAs. So 98% of the people are invested in publicly traded securities. That is awful over and redundant diversification into one asset class of publicly traded securities. So for true diversification, you really want to be in other asset classes like notes and like real estate. But the other thing is tax efficiency, right? So as the millennial generation comes up, just like any generation as they're coming up, who cares about retirement, right? I mean, when I was in my 20s and 30s, right, we're going to live forever. Who thought of retirement planning now? That's not cool. But what's really interesting is that the millennial generation invests and they trade like crazy. They trade meme stocks, they trade cryptocurrencies. And all of a sudden, in the last 2 years, they got hit by these huge tax bills. Holy smokes. And in some cases, if their portfolio in crypto went down, they owed more in taxes than they had to pay for. So what's really cool today and what's in is tax efficiency. It's been around forever, right? I can't encourage people enough to go online, Google compound savings calculator. Bankrate.com is one that I use all the time. And play with it. Just play with it. Play with the initial amount that you're going to put in, the rate or percent that's going to compound, and make sure you check the box that it's tax deferred, that it's in a retirement account, and it'll blow your mind. You do that for 15, 20, 30 years in a tax efficient manner. You don't have to talk about retirement planning. You don't have to think about retirement planning because you will have incredible sums put aside in a tax efficient vehicle. So, the last point I'll make on that is when I'm presenting to a crowdfunding platform why they should consider IRA or retirement money, that's where the money is. At any given time, there's $1 trillion in cash, checking account, savings account, taxable brokerage account. There's 35 times that in retirement money, right? So if you think about personally, if a 10,000 investment came along where you saw the opportunity to invest in notes and at $10,000, do you have it in your checking account where you're paying your mortgage and your car bill and utilities, right? Most of the time, it's going to be in your retirement account. Most people just didn't know that they can access to do that. So that's where the money is, and that's where your tax efficiency is. If you have a traditional IRA and you make a $6,000 contribution, you get a $6,000 tax deduction, which is great, and you get to defer it. Now, it used to be 70 and a half. That just changed. Now you can defer taxes without taking required minimum distributions to your 72. But if you use a Roth IRA and you contribute 6,000, you don't get the $6,000 tax deduction. But guess what? At the end, you never, ever pay taxes on that money. So it's the concept of taxing the seed versus taxing the harvest, right? We all know the stories out there of, these investors that have grown their Roth IRAs from $2,000, right, to $5 billion. Well, it's probably not going to happen to us because those investors happen to be private equity investors that had opportunities to get into some tremendous stocks. But we still have the same opportunity to grow and not pay taxes if we use a Roth.
Yeah, that's the thing is buying. We'll use a great example. I mean, you start a Roth IRA for $6,000. It's $500 a month. It's $150 a week if you want to put it in there. Putting a little bit in as contributions is so valuable because we see little small value notes there, and most of the time the smaller value notes do really well because they're smaller value, so you get a bigger discount. Buying it in your IRA and have that money come in, and it's tax-free growth, and then at $6,000 turns into 10 grand or 12 grand. And every year you do it, that tax-free growth is still valuable if you'll just start putting a little bit away on a, $6,000. I may not have an extra $6,000. Well, but I bet you have $500 when you did your tax returns. Let's start with something versus nothing, right, James?
That's where I go back to that compound calculator example. It's not whether you make 6% or 7% return. It's not if your fees are a half a point or 5/8 of a point. It's the time in the market that compounds, right? And everybody knows the example, right? If you put a penny in every day, for 30 days and that compounded, right, that equates to some crazy like 1.2 million dollars. It's the time that money compounds in a tax deferred or tax-free manner.
Yeah, I mean, now let's talk about it. Somebody asked me a question. What about the backdoor IRA? Can you convert a Roth to traditional or traditional to a Roth?
Yeah, so great question. And again, this is another thing to do and take advantage of now, because this was one of the other items in the Secure Act where they were taking it away. Thankfully, that got kicked out. So we can still do backdoor Roth IRA. So you can contribute in a traditional IRA if, and I don't have the exact number. It's in that ballpark range. If you're single and make 90-something $1,000, you can't get the tax deduction for a traditional IRA. If you're married, it's in the 170 to 180,000 range in 2022, right? But you can still contribute. You just don't get the tax deduction. So if you and your spouse both contribute, you can contribute $12,000, or if you're 50 and over, you contribute $14,000. You don't get the tax deduction, but you got the money in a traditional IRA, and now you can convert that traditional IRA to a Roth IRA. you got to pay taxes, but still it's the concept of taxing the seed versus taxing the harvest. I've read articles by financial planners that says it still makes sense to convert to a Roth, even if you're 80 years old, because of the way that it inherits. And then they have, used to be lifetime, now you have 10 years to distribute that. The compounding effect almost always points to a Roth being the way to go. So you can convert to a Roth IRA even if you don't qualify for the deduction. And again, do it now if you can. And again, remember, there's tax consequences. So always speak to your accountant, speak to your tax attorney, or and it's never all or nothing. So let's say if you wanted to if you have $100,000 portfolio, you don't have to convert the whole 100. You can convert 10. People do it and say, hey, if I have a mediocre year or a bad year next year in terms of income, and I'm not going to pay a lot of taxes, that's a great time to convert from a traditional to a Roth. If you have a gangbuster year and you owe a whole bunch of taxes, you probably don't want to do a big whopping Roth conversion, because that could kick you up into an even higher tax category.
Right. But it doesn't matter. I mean, you can roll over a smaller amount and do just to get it going and rock and roll. And that's one of the things, is getting something going. Now there's I don't know what the rule is, but if you've had was it a Roth IRA for 5 years, or I'm totally drawing a blank at the.
So there was the point that I should have included earlier when I said with a Roth, you never pay taxes. That's true, but you have to hold that asset for 5 years. So again, you buy a note for $10,000 and it doubles to $20,000. If you hold that note for 5 years, or don't sell it, right, for 5 years, then you got $20,000 in your Roth, which you'll never pay taxes. However, if you sell that note in your IRA before 5 years, then you will pay the taxes. So the principal, the contributions you put into a Roth are never taxable, and you can take them out the next day. If you put in 5,000, you can take out 5,000 a year from now. You'll never pay taxes on that. So contribution amounts never taxed. The profits or gains, you have to hold 5 years, and then you're good.
There you go. That's exactly what I'm talking about there. Question here from somebody. Tamiko asks, is if my income drops due to layoff or unemployment, I'm sorry, somebody asked another question here. Sorry here. If my income drops due to layoff or unemployment, that would be the best time to convert from traditional IRA to a Roth IRA. Yeah, because your tax. Exactly.
Just make sure you can pay the taxes.
Right. Exactly. Yeah, exactly. You pay the taxes on it. And David says, "Whoa, I've read that you just have to have the Roth account for 5 years, not that the assets inside have to be held for 5 years."
No, it's the time of the asset that is held, that's purchased.
Yep, good stuff there. You're also an active investor too, James. Let's talk a little about what you're investing in. I mean, because you aren't just a custodian. You're a guy who's rolling up and looking at deals and making things happen. So this is a little separate from the IRA, but let's talk about some of the things that you're investing in, enjoying, and doing some stuff with.
Yeah, so I have right now about 10% of my portfolio in publicly traded securities in my Fidelity. And again, I won't get too much in the weeds over there, but with publicly traded securities, you always have to have stops. So in other words, you don't ever want to take the ride down, right? It's the number one game of publicly traded securities is preservation, because when it's another conversation for another time, but the time that it takes to make up money that you lost is always a higher percentage, right? So if you lost 50%, it takes 75% to make up for that. So we always have stops. So this past February and March, I stopped out of almost all of my stocks and mutual funds automatic, because I set thresholds. If it trades below that, bang, they get sold. So typically I have 20-25%. Now it's down to 10% because those stops sold me out of that. So I've been in real estate as an investor in individual properties, single family, multifamily, 25, 30 years. But really in the last 7 years, almost all of my portfolio is in alternative assets through crowdfunding categories, which include notes. And so I want to be talking to you after this call. Tax lien certificates, fantastic strategies. Multifamily real estate is probably my largest holdings. And that's a great time to be investing because of 5 million shortage in apartments right now. So that's a great asset class. I'm invested in consumer debt, although Prosper and Lending Club were platforms that were originally built for the retail investor and have since gone really the institutional route, unfortunately. But to be able to be the bank and to be able to invest in the platform where you can pre-select 22 categories of investor credit worthiness. So you literally say, okay, I want to make 6%, I want to make 10%, I can even make 28% returns, knowing that I'm probably going to have 6 or 7% in write-offs at least, right? But just like the banks can build and structure and ladder a portfolio, there's a lot of what I'm invested now is small business refinance. So, you're investing in small businesses that will need inventory financing, short-term lines of credit. And typically a lot of these platforms, if you look at them closely, they're lending out money at 1.5% to 2% per month. So if you do the math on that and annualize that, I mean, they're making 24%, of which you can get varying degrees and percentages of that, but that's collateralized and backed by the assets with a 60% liquidation value. So if that company, so what they lent on was only 60% of what the company was worth, and it's short term. So your assets are backed, it's secured. So small business refinance, consumer credit, real estate, notes, tax lien certs. Interesting, I did a little bit with SoFi that will allow you to invest in alumni student loans. Brilliant idea based upon the affinity model. So let's say, if you went to Boston University and you wanted to refinance your student loan, well, that is refinanced by an alumni of Boston University. There's an association there. Originally, you have to be from that college or university. Well, nobody's going to stiff an alumni, right? So there was less than 0.5% in terms of delinquency or lates. Brilliant model, very brilliant. And that continues. It's still too early. I think in cryptocurrency, there are publicly traded securities, kind of like the gold rush back in the 1850s, invest in the PIX and the AX, investing in the infrastructure of blockchain technology, absolutely all day. Investing in the actual cryptocurrency, whether it's Bitcoin or Ethereum, it's still days are early. People, put small money in for some kind of diversification, but just like the internet in 2000, most of those companies are gone that offered internet access. A lot of these companies, these coins are going to be gone. So early days for that, not dipping the toes in the water yet.
Well, but the biggest thing about any type of investment, it's an investment. It doesn't mean a guarantee. You only want to probably put your money into stuff like that, hey, if it's gone, it's gone. That's all right. We learn, we play, we're gambling a little bit. You just know what you're doing, right? Not take your last 5 grand. Come on, baby.
Let it ride.
We got a couple questions here. Carolyn was asking, I think, a minute ago about, do you mean factoring receivables in some of the things that you're talking about in the business financing?
Yes.
Yeah. Let's see here. Tamika asked a question. So if I convert my traditional IRA to a Roth IRA, then is there a deadline date in which I have to pay the taxes owed? Is it April 15th, or can I work out a payment plan to pay the taxes owed? Or can you delay it to October 15th, like most people do with a lot of their taxes?
Yeah, You can, and again, please talk to your CPA. But my understanding is you can have an extension, but taxes are due April 15th. So if you don't owe any taxes, you can extend your filing to October. But if you owe taxes and you extend to October, you're going to pay penalties on what you should have paid on April 15th. So taxes are always due April 15th.
Yeah, exactly. That's why they say if you think you're going to owe something, it's better to pay it then versus letting it drag out for another 6 months or further, which is good stuff. What's the what's one thing about self-directed IRAs that people do that just bug the shit out of you, James? What's a pet peeve that you see people do? You're like, oh, what did you do that for? With your experience,
not know the asset class that they should have. And so they get frustrated and then they turn around and then they sell the asset. And then in many times, especially if it's a type of private equity or private debt structure, they will require a 3 to 5 to 10 year hold for a purpose. In a lot of these situations, let's say in multifamily, well, if you're investing into either a direct property or a fund that has to go in and renovate the properties, get all new rent, sign them, and it takes 6, 9, 12 months, sometimes 2 years to get cash flowing positively. And they might not see anything in their account for the first year. And they just think, I got ripped off. I'm not seeing anything out of this. And they sell at a loss. And, if there is a lock-in period, then they're going to take a real ding, not only on the interest that they lost, but on the principal that they invested. So it really is so important to pay an attorney $1,000, whatever, or a business person that knows that asset class, and do your homework. And it's not always possible, but at the end of the day, after you speak with that advisor, you should probably be able to speak to the advisor, as give them back what they gave to you and really understand what they just explained to you, and you have to understand that explanation.
Yeah, I think that's one of the most, it's understanding the asset. You said understanding the asset class and the timing of that asset class or that deal, what's going on, stuff there. I think
my first real estate deal, a dopey 24-year-old kid, I had no idea what I was getting into. And then I was 88, 89, and then the market fell out. It was a perfect example, and I went backwards. I had no idea of real estate transactions, the cost of fees, what was involved with tenants and crazy tenants. And I mean, just a classic example. You got to start somewhere and you got to learn. But please, if you can get a great advisor, learn, go to school, join organizations and memberships, best thing you can do.
You surround yourself with like-minded individuals, people that are actually doing it. It's such a huge thing. Yeah, it's part of the reason we're here, to put people in place with new thoughts and new ideas, and helping people take their businesses to the next level out there. Because it all starts. I mean, little steps have big. I mean, big things always have small beginnings. You know what
Absolutely.
I mean? And whether it's learning something new, or like we were working with Ravel earlier, reaching out to investors. That'll be one question I ask you. Maybe you answer this. Maybe what are some of the things that if somebody's reaching out to somebody who's got a self-directed IRA fund or something like that, or investors, what are some tips that you would recommend for people to stand out, things to do or not to do when maybe reaching out and raising capital, or talk with IRA investors to see if they can fund their deal?
One of the first things I mentioned again is the two things that you really need to know. One is IRS publication 590. So that's how much can I put in my IRA? That's my contributions, right? How much can I put in? Can I roll it over, right? What if I overfund my IRA? How do I make that work? So the simple things of what an IRA is and how it works, that's really important. But the other big piece of that is what's the IRS code 4975, which is all about prohibited transactions, because a lot of people, when they start out, do business with people they know and family members. And that's, unfortunately, with self-directed IRAs, you can't do business with family members. And it's just natural that, you have a couple brothers, or, your father thinks he's doing the right thing and trying to bring you into the business and teach you and show you. You just have to know the ins and outs of prohibited transactions. And here's another nugget. All right. So your father can't do business with you with a self-directed IRA after the fact, right? He can't let you rent the property. But family members, prohibited people, family members can come into a deal at the same time if there's no prior interest or ownership. Again, $100,000 piece of property. Dad comes in with 50,000. Daughter comes in at 25,000. Son comes in at 25,000. At the same time, you can do business with prohibited people, and that asset has to be portioned out ownership by those exact percentages. So here's what you see often in that case: dad gets 50% of any profits, proceeds, income. Daughter gets 25, son gets 25. What I've seen happen a lot: dad takes 5 because dad's a really good dad, and the kids get 45 and 45. Prohibited transaction. So you can come together at the same time. Husband and wife can come together at the same time, but it's always at the proportionate ownership that they come together with.
Well, that's the thing. It's yeah. I think you can partner together. So and so fund, and you see that. You'll see that on a lot of some of the county records. So and so used 20%, another 10%, 15%, and that profit's got, whatever the profit is got to go back into it equally, and the same amount there. What was invested with and stuff like that for you, and you can invest with your IRA at the same time. You're going to fund 50% cash, and then you're going to use 50% of your IRA to buy a property as well. Just got to go back in equally in the same thing.
Very impressive.
Yeah, we've done a few of these deals. Well, but that's the thing is if you're buying notes, you got to, that's the thing. If you're going to buy a note, you need a copy of the note. You need a copy of the value of it. You've got to have all the assignments. You got to have the assignment made out to your IRA, and that's got to be labeled properly. And same thing, when money coming back in, you can have your servicing company put it direct back into your IRA. It's just checking off boxes and making sure what you can and cannot do and stick it to. It's very, very black and white. There's no gray when you're dealing with the IRAs, right?
Yeah, and it certainly, the custodian is there. They're always going to have disclaimers. They're always going to say we cannot give advice, right? But there is, of course, the CISP, Certified IRA Services Professional. Mm-hmm. It's an 5-day, 8-hour a day course over 5 days with a 4-hour exam. It's not the Series 7, but it's very comprehensive. So when you're talking with the self-directed IRA custodian, that would be maybe to your earlier question, if the representatives there have their CISP, Certified IRA Services Professional, and they'll know, and they can give you feedback. They can't give you the exact answer necessarily often if it's kind of convoluted or twisted. It will often go to compliance for that self-directed IRA custodian. They will come back with black and white, and they will say, yes, we can do this. No, we cannot do that.
Right.
In some cases where and I always say IRS code, it's not gray. It's black and white, right? Either you can do it or you can't do it. They're going to come after you or they're not, right? So there's not really a whole lot of gray. But and I can say this because I'm originally a New Yorker, and when I was just somehow with folks in New York and New Jersey, they came with every possible scenario of how they can get around the IRS code. I'm like, no, you can't do that. Joking aside, very creative people. But many times, if it really still seems gray, What the IRA custodian will do, very clever, very smart, they'll say, sure, no problem. Get your attorney to write a letter and cite the IRS code, and that the attorney is putting their license on the line, and they're approving that you'll do it, and we'll do it, no problem. And I've never seen that investor come back with a letter from their attorney, because no attorney is going to hang their license out there. And that's so. If the custodian is saying compliance says no, we want a letter from your attorney, I've seen people push it. I would really let it go. You don't need the aggravation. There's always another deal out there that is a little bit cleaner.
Well, and that's the thing is you push it, you potentially risk invading your whole account or losing it if it turns out to be a prohibited transaction that the IRS says no, that you can't do that. It's not good to play with Russian roulette with a loaded gun in some cases.
Yeah. Also, back when I was a dumb 24-year-old kid, I met the IRS, and I never want to meet them again.
That's true.
I've never met the SEC, and I never want to meet them. So
yeah. The closest I can name an SEC, I was on a wine tasting, and one of the auditors, the SEC, was on a wine tasting tour. So I spent the whole day with an SEC advisor.
I hope you took notes.
Oh yeah, I think this Frank, he's out of Miami. I was like, cool. He's like, oh, I'm here on vacation. Never mind. Enjoy your wine. Let's get stuff. Somebody asked a question. What's the best way for folks to reach out to? I know your website's going. You're tweaking the website and some other things there. You got the new book coming out in a few months as you're consolidating it. What's the best way for our audience to connect with you? And if they want to open it, are you able to help open up a self-directed IRA account for folks if they're interested? How do they do that? Absolutely.
So just reach out, J Jones at IRAexchange.net.
I'll type that in the chat roll for everybody. So
thank you.
Yep, J Jones at IRAexchange.net. That'll go to email and stuff like that. And you've got, like I said, you've got some. You mentioned doing some really cool things out there. And the website. When you said the website will be about another week or so before it's re-edited, or a little bit longer than that?
You're correct. Yeah. So we're one of the, again, this comes out of just being in this industry for 10 years, and people say, gee, I had a really great experience investing into this asset class. What else can I invest in? So we're looking at launching a registered investment advisory that will offer different categories of asset classes to become familiar with. So it's just like when you're talking to your Fidelity advisor, gee, you should be in small cap, large cap, technology, biotech, US domestic, international. There's this huge gaping need for people to learn about alternative asset classes. And you and I are going to talk about that.
Yes, we'll talk about that definitely. James asked a question. Can you talk about solo 401ks?
Yeah, so that is a type of investment plan for the self-employed. So it's usually it's for typically a owner and a spouse. You have the ability to fund it with the contributions. I think they're in 2022, it's 19,000, and then there's a catch-up provision to that. There's also another entity in the solo 401k where it acts like a SEP, a self-employment plan. So you can take a portion of your income, your net adjusted income, that gets deducted off your taxes, and you can make a contribution. I believe for 2022, you can contribute up to $57,000. So that is, holy smokes, right? IRAs are great, putting 6 or 7, but a solo 401k to, if you put away 50, again, go back to the compound online calculator, put aside $57,000 a year for 10 years, at making 8%, 9%, holy smokes, the numbers become staggering.
Mm-hmm, exactly. Now, who can't have a solo 401k? I know there's some specifics. If you're working at a regular job and have a 401k, can you have a solo 401k as well, or no?
So yeah, I love this question. So the answer is, if let's say you work as a CPA all right, by day. And then you have a side business in real estate. If that business is substantially different, which you're a CPA, if then you do tax returns at night, you can't have a separate business and a separate solo 401k. But if you work as an accountant or a doctor, right, and have a 401k at that business, and then you have another business where you refurbish cars or you're a real estate entrepreneur, you absolutely can have a separate solo 401k as long as your side business is substantially different from your day job. Holy smokes, you do the math on that.
Right. Is there a specific amount you need to have making or that you need to contribute to a solo 401k?
So again, you do not have to contribute the maximum amount allowed. It's really a combination. If you made $50,000 and your net is 20,
Just do a Roth. Yeah.
You're starting out, maybe you can contribute 5 or something like that. So there's no minimum amount. There's only a maximum amount of what you can contribute.
Right. Let's see. Got a couple questions here. Ravel asked the question. You missed. What's the process converting from a 401k? Well, if you've got a 401k already at a job, can you take a chunk of that and move that into a self-directed IRA, or do I have to wait till I leave the company to roll that into an IRA?
All right, that's a great question. Here's another nugget for you. And again, this is only, if you're in the trenches long enough, you kind of hear it all, see it all, right? So really, when we talk about 401k rollovers to an IRA, 99.9% of the time, we're talking about a 401k that you left behind at another company. You no longer work at that company. That company really doesn't want your 401k because you're not there at the company and they're paying for your management expenses to a degree. They want you to take it with you. So if you can take it and roll it over into your new company's 401k, or you can roll it over into an IRA, 99.9% of the time of those discussions. However, if you are working currently at a job and you have a 401k, there is a thing called an in-service transfer. And it's in the guidelines of when you signed up for that 401k. It's in your administrative package. They will tell you whether or not you can do this. And typically the parameters are, this is newer, like within the last, so if the plan is newer within the last 5 years, it may have this feature. If it's an older 401k, probably doesn't. But they will allow you to roll over up to 50% of what you contributed. So you have a $100,000 IRA, you contributed $75,000. They may allow you to roll over $37,500, half of what you have contributed. But I can pretty much guarantee you, when you hop on the phone tomorrow to say, hey, I want to do an in-service transfer, they'll have no idea. I had a discussion recently with the CFO of a company who wanted to do this. He happened to be the liaison for the 401k company. And he said, oh, no, I'll pick up the phone. I'll call the treasurer myself. I'll get this. They had no idea what he was talking about. He called me up. He said, Jim, you have no idea what you're talking about. They never heard of an in-service transfer. So it's not well known, and you're likely going to have to go up the management ladder to get them to do that. So it's in the provision if they allow it. If they allow it, it's typically 50%.
Yeah. And I know the actual first attorney that ever was able to get that done back, Henry Novak, who lives here in Austin, Texas, actually back years ago when he was able to do some of that stuff there. He had to fight, and he actually got it approved in a couple of cases. So get a quick, I'm sorry, go ahead, Jim.
You are a very modest guy. You never told me that you never let on that you knew about that. And you're, I think, the first person I've ever spoke to that knew about that. So
I learned. I've educated myself as best I can there for you. Most folks don't know. But it's what you don't know, some different opportunities there. So Fatima asked a question. Also, what is EQRP? You know what that is? EQRP or
No.
Or some sort of retirement plan? EQRP. RP stands for retirement. I don't know what. Fatima, you may have to clarify that. Can you roll over a 401k from your current company to a solo 401k while you were still employed?
Ooh, that's a good question. I would think technically, well, that would actually, again, I think that would be an in-service transfer, right?
Right. I think that's what it would be there. Yeah.
That would be number one. It would be an in-service transfer, but number two, you'd be telling them in an indirect way, "Hey, I'm resigning. I'm
going to my full-time gig over here." Yeah, what I want to do.
So be careful with that one.
Yeah, exactly. Be careful. Exactly. So that it says, is it advisable to also have an asset manager manage your rollover Roth IRA, or is it better to have it invest in real estate? I think it all depends on what you're investing in. You can't really give any financial advice. You can invest your rollover Roth IRA in real estate. Yeah, as long as it's in with a custodian that specializes in self-directed IRA accounts. Yeah, you can do that. It just depends who your custodian is, who your trustee is, right?
Correct. Yes. And in terms of that one part about advice and advisor, most of the time that means when you say advisor that they're with a brokerage firm. If they're with what we call a wire house, Merrill Lynch and Morgan Stanley, JP Morgan, they're not going to touch that with a 10-foot pole. For two reasons. One, the assets under management is going to go out the door. And they don't want to do that. They don't want to see that. Number two, they actually don't, under Dodd-Frank, they no longer, they cannot take on any fiduciary responsibility for somebody that's going to invest in a note, right? Because God forbid the note goes bad, and holy smokes, now that the Merrill Lynch guy is hung up on that. There are, and this is kind of what we're talking a little bit about, what we're trying to do. There are some RIAs, registered investment advisors, that do have experience in alternative asset classes like notes that can help you. And that's a very small piece, but I think that is going to be the future. Again, as we take a look, baby boom generation looks at their portfolio 3 times a month, and they're 99% invested in public securities. Millennials look at their portfolio 8 times a day. And they're very much into alternative assets. So I think that is the future.
Mm-hmm. Yeah, it totally is. I mean, people are looking for different options that they can understand and take advantage of. And I think it's basically because a lot of folks believe Wall Street's rigged or the stock market's rigged. That's if you're not swinging a big bat with Wall Street, something like that, it's hard to make a lot of money and be on top of this stuff in some cases, huh, Jim?
Yeah, with the programmed algorithmic trading that's done, you can't. It's very, very difficult. Up to 2 years ago, I was still trading 25 times a day, even though I was invested mostly in alternatives.
Right.
Today, man, it's hard. It's really hard. And I've paid $10,000 for this software trading program and that software trading program that looks at technical analysis, and it's very hard today.
Yeah, and then especially when you look at all these, they call them dark pools that some of these big investment companies run. You never know what's being traded in there.
Absolutely. So you do your homework, you study notes, you make your really nice returns. You can control it. You can be the boss. It's worth doing your homework and studying and becoming good at it.
Is there a newsletter, a periodical that you subscribe to that you love to get information on, that you like to stay on top of things? Any newsletters?
Digital Wealth News is one of the newer up and coming D-Wealth News, and I think they have now over it's 100,000 unique hits every month, and they're completely focused in the alternative asset space.
Nice. Do you ever see, this is my personal question, family offices, how much are they playing in the self-directed space? Do you see a lot of that or not so much?
Not so much. It still goes back to the cumbersome process, right? And when crowdfunding started, the whole model started changing, as I said earlier, from B2C to B2B2C. So if you were a self-directed IRA custodian and you hitched your wagon to Prosper, oh my God, you'd be doing all these self-directed IRAs. So around the 2014, 15, everybody started hitting up family offices, and they use them conservatively, but they also have a pretty big iron gate that you got to get past. So not as much as you would think or hope. There are groups and associations that you can join with family offices where, if you're a deal sponsor and you're trying to tap into that, you're striking gold, but it's a long journey to get involved with family offices.
Yeah, there's a family office group that hosts a couple events, one in New York and one in Boca Raton, that we've been tapping into and going to that stuff, especially when we're working through our fund and getting our 506C, 506B and 506C, and then before our Reg A. So we're jumping through those hoops, and I'm gonna be hanging out in a little bit of those places from time to time.
Yeah, there's love to talk to you offline. That group out of Boca is it's the largest group there is. I think they have 1,000 family offices. They're great folks.
Yeah. Okay. My rep actually lives out in your backyard, Scottsdale, actually. She's got a Miami number, but calls me from Scottsdale. So Carolyn asked a question. She said, did you mention at the beginning that you have written some books?
Yeah, I have a couple books on Amazon Kindle, 59.5 Q&A, questions and answers, the Self-Directed IRA workbook, and then prohibited transactions. Those are all coming down. Literally, I'm also about, when we talked about website, I'm also republishing that book. That book will be out in the next 30 to 45 days. And that will include all of the things that we talked about that's new, like under the Secure Act and what you can do. It's so much of it is already 2 years out. That act was 2020. Now they're going to pass an updated version at the end of this year. And so there'll be even more changes. So a lot of it is just outdated 2 years, 3 years ago. So be launching a new book in the next 30 to 45 days.
Well, that's the thing. Things are always constantly changing. You got to know what's going on, and what was true 5 or 10 years ago is not true these days. You got to know what's going on in the market these days. So
that's for sure.
James, thank you so much for coming on and spend time with our audience today, and just really provided great stuff there, guys. We put his email in there. Reach out to him. jjones at iraexchange.net.
Correct.
And we'll talk some more next week too, James. All right.
Oh, I look forward to it. Thank you so much. Really an honor to be here.
Thank you, sir. Have a great rest of your weekend. Enjoy him. Looks like you got unpacked there, which is good, but enjoy it.
Off to the pool.
Hey, there you go. That's what I would be doing. Sounds good.
Take care.